Good evening. Thank you all for coming in here. It's a pleasure to have you on board. Lots of new members, lots of new faces, and the usual board members. First, I'd like to thank each and every one of the board members of the council who have been very helpful, very supportive throughout this year, and hopefully more to come next year. Just want to say a couple of things before we start this for the new guys in here. We're not a political organization. We are apolitical. We are here to brainstorm ideas. The problem in the world today, especially in the United States, there aren't enough problem solvers. There are problem creators. We need to find solutions. The mandate of the Financial Policy Council is to find solutions, is to brainstorm with people who are on the inside, who know what's happening. We've targeted 3 sectors, 3 markets, 3 geographies, and we're here to attract, as a magnet, all the talent in these 3 sectors: Washington, D.C., Wall Street, and Hollywood. To bring in the best and to find solutions for the country's economic woes. This is what the council is all about. We're not going to argue about the political position, whether you're Republican or Democrat, it doesn't matter. This country needs solutions more than ever. This is what we're here for. If you agree with that, if you support that, then you're going to be very happy here and you're going to support us. By the way, this is behind closed doors. Anything you say here, any questions you ask, is not going to be done by the media or anything. What happens here stays here. Anyway, as a speaker today, we're going to have one of the most preeminent wealth managers in the nation, Adam Frank, who's the head of global wealth management at JP Morgan. Adam used to work for Bear Stearns when JP Morgan was when Bear Stearns was acquired by JP Morgan in 2001. He joined JP Morgan. Before that, he was a lawyer with Schulte Roth, Sullivan and Cromwell. Very successful career over the last 20 plus years in law and wealth management, dealing with family offices, wealthy individuals, etc. Adam is exactly the kind of speaker that we bring in on board. People who are on the inside, people who really know what's happening, people who can share with you views, ideas that you don't read in the papers or anywhere else. Ladies and gentlemen, let's welcome Adam Frank.
Thank you, Ziad. That was an effusive introduction, and thank you, everybody, for coming. A lot of people were saying to me that they came from Florida to see me speak, so hopefully I'll live up to that billing. The obligatory joke that I have to tell you I found on Wikipedia this afternoon. I was looking for a joke to open with. So 3 gentlemen. It started out as an Englishman, an Irishman, and a Scotsman, but I didn't want to offend anybody in the audience. So it's just 3 guys up on a cliff, and they meet a wizard who says to them, "You're going to have to jump off the cliff, but I promise you that if you say something as you're falling, it will appear at the bottom." So so one guy goes first, and as he jumps, he yells, "Pillows!" And sure enough, he falls on pillows. So the second guy jumps, and he yells, "Hay!" And sure enough, he falls on hay. And the third guy runs to the edge of the cliff, and as he's about to jump, he trips over a rock and says, "Oh, shit." Which I thought was an apt joke, which is great that it's a cliff joke and the shit joke, because that's what's going to happen, right? That's where we're ending up. There's a lot of things that are now, as a result of President Obama's re-election, more likely to happen. We're more likely to go over the fiscal cliff than we were prior to Tuesday. And you've seen it in the papers, you've seen it in the news on TV. the headlines every day now. It's fiscal cliff, fiscal cliff. Why did the markets go down? It's the fiscal cliff. Now, nobody knows what that means, but everybody knows that it's because of the fiscal cliff. The fiscal cliff, as I'm sure you all know, it's the combination of tax increases and spending cuts that occur automatically as a result of the budget negotiations last year if Congress doesn't act. And unfortunately, congressional inaction is the sine qua non of this Congress. It's a lot of what happens in Washington is gridlock, and the political gridlock doesn't look like it will have shifted as a result of the election. If anything, the Democrats picked up a couple seats in the Senate, but the hardliners in both parties seem to have done very well. And unfortunately, it means that there's probably going to be more intransigence than compromise. There are three possibilities. So if we go over the cliff, we'll come back, right? There's not a question of, is there going to be a compromise? Is there going to be a deal? It's really a question of when it happens and what it looks like. All right, so when could it happen? It could happen this week or next week. That's not likely. It could happen before Congress recesses, which I think is December 16th or 23rd. It's right before Christmas. They go on vacation again after about 5 weeks of being in session. They went in session yesterday. Maybe it happens, but again, given the makeup of Congress, given the fact that the makeup is not changing very much, it's not certain that Congress can even come up with a compromise framework to kick this can down the road for 2 months or 3 months or 6 months. And the uncertainty, what the business leaders who met with the president yesterday said pretty much to a person is it's the uncertainty that's killing us. Right? It's uncertainty. It's not knowing what the rules are going to be next week and next month and next year that is really hurting business. It's hurting investment. It's hurting infrastructure investment and so forth. So whatever happens, it needs to be certain. It needs to be certain for a period of time. Kicking the can for 6 months just kicks this decision down the road and probably has negative macroeconomic effects. What I want to talk about today, more specifically, and I want to talk for about, my goal was to talk for about 20 minutes, open it up for questions. But if anybody in the audience has questions as we go, whether it's on topic or not, we can make this as interactive as possible because I think it's going to be much more useful for you if I'm talking about things that are important to you. So the things that I had planned to talk about, and what I have 20 minutes to 2 hours, depending on how long you all want to be here, is a discussion about how the tax increases affect us as individuals and as business owners and as people who are being targeted by a lot of the policies that are either going into effect by default or that were in the president's budget proposal in February, which is now back on the table. And there are a lot of things that were in that proposal in February that any number of people who are in positions of power, positions of knowledge, said, that's interesting, but that's a position. That's not likely to become legislation. Nobody would let it happen. It's now, I think, more likely for some of those things to become legislation. And there are specific things that I'll talk about. So the tax increases that will affect all of us. So now the tax rates, as you know, and there was a paper that was outside, this a thought piece that J.P. Morgan published as a result of a lot of the work. Hopefully you have it. If not, you can pick it up outside. There are a number of tables in there. One of them talks about tax rates and how they're going to change. The top two tax rates, the bottom tax rates, the 10% rate goes away, it goes to 15%. The thresholds change. The top two rates go from what they are today to 36, I think it's 31 and 35% go to 36 and 39.6%. So ordinary income gets taxed at higher rates. Interest income gets taxed at higher rates. The dividend tax potentially goes from 15% where it is today to 39.6%. Dividends, as you recall, before 2001 were taxed at ordinary income tax rates. In addition to all of those rate increases, which are automatic if Congress doesn't act, automatically on January 1st, and even if Congress says it's going to act next year, it causes tremendous chaos because employers don't know what to withhold for their employees. Businesses don't know how much they're going to have to remit to the government at the end of the month or the quarter. And not knowing as of December 31st will have bad implications. And I've said it to a few of you outside, but markets drive policy and politics, and it's not the other way around. And for those of you who remember the first vote when Congress thought they were going to be badasses and voted TARP down, the market was down 800 points. And they woke up the next morning and said, okay, we got to get this done. And a couple days later, they voted TARP in, and the market was up 1,000 points. And unfortunately, I think that's what has to happen. And I don't think the last week, where the market's down about 600 points over the course of time, is enough to do it. It needs to be a sharper contraction. So the tax rates go up. There's an additional tax that was imposed by the Affordable Care Act, by Obamacare, of 3.8% on net investment income over certain thresholds. So if your adjusted gross income is over $200,000 for an individual, $250,000 for a married couple filing jointly, there's an additional tax imposed of 3.8%, even if the dividend tax rate stays at 15, even if capital gain stays at 15. There's a 3.8% percentage point increase. So it goes from 15 to 18.8% on capital gains taxes. Dividends potentially, so 3.8% on all of that. The capital gains rate is scheduled to go from 15 to 20%. That's definitely on the table. I think it's more likely than not that that's where we end up, whether it's as a result of going over the cliff or as a result of compromise, which means the rate on capital gains effectively becomes 23.8% from 15%, which is almost a 60% increase in your rate. Dividends, even if they remain qualified to be taxed at capital gains rate, will be taxed at 23.8% from 15, and then potentially 43.4% if you include the 39.6 plus Obamacare. It's nasty. It's not fun. But that's where Congress is. That's where the law is. The Obama administration's budget proposal from February did all of those things, but only for people making over $250,000 a year. So for those of us in this room, for most of the people we know, we're the people who are impacted by all of this. In California, those of you who follow this might know, they passed Proposition 30 on November 6th, and increased tax rates on high-income earners, which is anybody earning over $250,000, by anywhere from 1, 2, or up to 3 percentage points. So the top marginal tax rate, if you're a single person earning $1 million or a married couple earning $2 million, is now 13.3%. They also increased the sales tax by 0.25%. The sales tax increase is effective January 1st, 2013. The personal income tax rate increases of up to 3 percentage points is retroactive to January of this year. People are going to have to start paying in additional taxes to make sure that they've withheld enough for state purposes. So there are a lot of people who have said, well, you can't have a retroactive tax, you can't make these increases retroactive. If we go over the cliff January 1st and Congress doesn't reach an agreement until February or March or May, it's not likely to be retroactive. It will be retroactive to January 1st. I believe it will be retroactive because Congress can. They can't impose a new tax retroactively, but they can certainly change taxes, change rates retroactively. There are other changes. Some of them are in the paper. If you're interested, there are a number of pieces that I've put out. The payroll tax holiday of 2% on wage income goes away. There's an additional 0.9% Medicare tax, Medicaid tax on earned income. So your earned income ordinary tax rate today is 35%. Medicare adds 2.9% to that today, so it's 37.9. Adding another 0.9% plus 39.6 brings you to the same 43.4% that dividends potentially are going to be taxed at. For those of us in the room, for those of you who have friends, family, who have significant wealth, want to transfer it to children, gift and estate tax provisions that are either, again, part of the cliff or part of the Obama administration's budget. Currently, the exemption from gift and estate tax is $5.12 million per person. So a married couple can transfer almost $10.25 million to their kids, completely transfer tax-free. If you put that in a long-term trust, a dynastic trust, and apply exemption from what's known as the generation skipping transfer tax, you can transfer that money and all of its growth out of your estate pretty much forever, for a long period of time, many hundreds of years potentially. If we go over the fiscal cliff on January 1st and the law reverts to what it was in 2001, the exemption amount goes to $1 million from 5.12. And the rate starts on the first dollar over that at 41% and increases to 55% for bequests or gifts of over $3 million. That actually goes up to 60% once you get above $10 million for the next 7-point-something million dollars to recapture the benefit of the lower brackets. And then it goes back to 55. So you're effectively paying a flat 55% tax if you have more than 17 or $18 million. Even in the Obama administration's budget proposal, which provides for a $3.5 million estate tax exclusion and a 45% rate, which is where we were in 2009 on those numbers, the gift tax exclusion, the amount you can give during your lifetime tax-free, remains at $1 million. So there's an opportunity this year to give away significant assets to provide for your family to keep the money out of the reach of the U.S. government and of certain of state governments, unless you live in Connecticut, because Connecticut is the only state in the union, now that Tennessee has repealed its gift tax, that imposes a separate state-level tax on gifts. So if you live in Connecticut, your maximum gift that you won't pay any tax on is $2 million. And after that, you start paying tax from the first dollar of gift. There are ways around that by giving assets that aren't located in Connecticut. But if your biggest asset, the asset you want to give away, is your home, and your home is in Westport, you can't move that out of Connecticut. So it has become problematic for many people to try to give assets away. So let me talk briefly about a couple of ideas that we're talking to clients about. Some of them you've heard, some of them maybe not. They all revolve, obviously, around timing. Right? This is a matter of timing. There's an opportunity in the next 6 weeks to avoid, assuming Congress doesn't act this year, which I think is probably an even bet, the other side of that being they act, but not till December 23rd or 26th, the way they did, if you recall, for anybody who was paying attention in 2010, right? In 2009, estate practitioners were saying Congress will never let the estate tax go to zero. And sure enough, Congress let the estate tax go to zero and didn't pass a law until late December of 2010, retroactive to January 1st, basically saying, all right, if you died this year, you get to pick, do you want to have an estate tax and a step-up in basis, or do you want to have no estate tax, but your heirs have to carry over your basis? And there were a number of high-profile deaths, Glenn Bell of Taco Bell, George Steinbrenner, a couple others, who paid no estate tax on multi-billion-dollar estates because of the luck, if you want to call it that, of their timing, the timing of their death. And so death this year is excellent tax planning, but we're generally not recommending that to our clients. Accelerating capital gains, right? I think one of the reasons that the market has been down over the last week is, in addition to the general disappointment, and I think the real disbelief in the outcome by a good number of market participants, I think people are saying, oh my God, this is real. It's much more likely to happen now. I got to take these gains. I've got to lock in the gains that I have. The market was up 17% at one point this year. It never felt like it over the course of the year. It felt like a terrible market as we went on. It was the summertime. Nobody felt good, but the market was up 10, 12, 15%. There are still plenty of people who have gains. Selling them now is a good idea if you don't have carryover losses, because you have to net your losses against your gains. But if you don't, and you can sell now, assuming you're going to sell the asset anyway, locking in a 15% rate now versus a certain 18.8% rate next year, right? So the 3.8 percentage point difference is like a 26% return on the investment of your tax dollars, if you think about it that way. You're paying 15 cents on a dollar today to avoid paying 18.8 cents per dollar next year or the year after. And if you ignore the time value of money, and currently money has very little time value for short-term investments, that's a good investment. If the capital gains rate goes up to 20% and you add the Obamacare tax, so you get a 23.8% rate, your investment of 15 cents per dollar in paying taxes now yields you over a 56 percentage point, a 56% return over a year if you plan to sell the same asset next year assuming that rate goes to 23.8%. If you have a position that you like, buy it back. There's no wash sale rule with respect to capital gains. And a lot of people have been conditioned by their financial advisors, by their attorneys, by their accountants, that if you sell something for tax reasons, you can't buy it back for 30 days, right? You got to be naked for 30 days. That's only for losses. The wash sale rule only applies to losses. And a lot of clients express surprise when we talk about that. But you could sell Apple stock and buy it back 5 seconds later, 10 seconds later. Less liquid securities, you need to have enough time that you're exposed to the market. Stocks that trade by appointment, you might want to wait till they're overnight. Taxable bonds, interestingly, if you bought a bond a few years ago with a relatively high coupon, right? Interest rates have been coming down, bond coupons have been coming down. If you have a gain in that bond, part of the gain is the anticipation in the market of the receipt of the high coupon, right? Part of the premium in the bond is an acceleration of the income. If you're going to pay ordinary income tax, this works for taxable bonds, not as much for municipals. You're going to have taxable bonds and you're going to earn income at today a 35% rate, tomorrow or next year maybe a 43.4% rate. And you can accelerate some of that income by selling the bond today and realizing it as a capital gain at 15%. Why wouldn't you do that? And in fact, you can take the proceeds from that bond, and again, assuming you're not crossing it, there's no issue with whether you actually had market exposure. You buy back the same bond at a premium to keep collecting the coupon while your yield to maturity declines because you're buying it at a premium and you're still getting the same percentage coupon, you're the same dollar coupon. You've now manufactured a tax loss because you're going to be able to amortize that loss and either offset some of the income as you earn it or write it down when the bond matures. So there are a number of different things you can think about, and I'm sure you can think of different assets that you might be able to do this with. One thing that we thought was interesting, if you have covered calls, if you're doing a covered call strategy, an income strategy, where you've got calls that expire in January, February of next year, you know that when a call expires, that's when the tax impact happens because it's a short-term asset, it's a short asset. You can, depending on where the premium is, where the strike is, it might make sense for you to accelerate the transaction and close out the call, close out the position in December when you're paying 15% and not wait until January, February when the call expires. And people who are doing these programs, oftentimes they're on autopilot because you're just staggering them. This is the time to think about it. If you've got a business, most of the time in most normal years, you want to push off your sales and your sale realization into the next tax year. And you want to accelerate your losses and your expenses into the current tax year. And this year it's all backwards. You want to accelerate those contracts. You want to take the income in this year when it's going to be taxed at lower rates. You want to make those sales this year when your rates are lower. And you want to think about this from a business perspective. Is there anything you can do? So I think that for purposes of capital gains, as the year goes on and more people are doing this, as Congress doesn't act, every day Congress doesn't act, I think more and more people are selling. I think there's some market risk there that some of the gains go away. And again, if you like the position, buy it back and reestablish it. But you're reestablishing it at a lower cost, and potentially you can wait a few days or a month and buy it back in December. The risk is Congress acts before that. I can't tell you what the odds are. Ziad introduced me and said there are a lot of people in the know. I have no idea. Nobody has any idea. Anybody who tells you they know what's going on, unless they're the president or John Boehner, is lying, because nobody has any clue what's going to happen, because it's politics, and there's a lot at stake. Both sides believe there's a lot at stake if what they believe to be important doesn't go through. I thought he was getting up to tell me I was done. I had to start taking questions. Am I done? Is it time for questions?
5 more minutes, please.
All right, good. So dividends, right? Dividends become less valuable depending on what the rates are, but one thing that I think has started to happen and is likely to continue to accelerate is companies are likely to pay special dividends, right? As a return of capital to shareholders. The two ways companies do that are buybacks and dividends. This year, it makes a lot of sense for companies to issue dividends. A number of firms have done it. I can't recall offhand. HCA did it to its private equity owners. There was another company recently that had a large dividend. So to the extent you have companies, you can research companies or talk to people who know companies with large amounts of cash on their balance sheet. I was talking to somebody about Apple. I think they're probably a good candidate. I have no idea whether they're going to, and I wouldn't buy Apple just because they might issue a special dividend. But to the extent there are companies that are looking to return capital to shareholders, and Tim Cook is trying to be the anti-Steve Jobs, it looks like, and Jobs didn't like that. There's a lot of cash on corporate balance sheets, so we think that there's a lot to that. On the gift and estate tax side, particularly for individuals, if you have assets that you want to give to your kids, assets that you want to give away, give them now. If you've got existing trusts, use them, because it's now November 15th. If you haven't talked to lawyers about this, if you haven't started the process of planning, it may not be too late, but you need to go to your lawyer yesterday and get things started. Because think about what it takes to write a will, to draft a trust. Right? You need to think about a lot of different things. It doesn't happen overnight. The lawyers are telling me that they're totally backed up already. Their staff is all hands on deck. They've canceled Christmas vacations. Nobody's leaving the office for the next 6 weeks. And even then, they're not sure they're going to get everything done. And then once you get a trust created, if that's your route and you want to transfer securities, to have a trust open a bank or brokerage account nowadays is a 3, 4, 5-day process between Dodd-Frank and the Patriot Act and all of the various regulatory concerns that the financial institutions have of opening new accounts and documentation requirements. It's going to take a lot to get things done. You can do it more easily if you've got existing structures in place, if you're just giving assets directly to individuals. But absolutely making lifetime gifts. I want to be respectful of the time, and I'll actually stop here and we'll open it up to have a discussion. There are certainly techniques that you can use to make the gifts less irrevocable than they theoretically have to be for tax purposes. There are backdoors and various other things. I'm happy to talk about anything specifically. But the idea here and what we've talked about with clients, what we're talking about tonight is think about what you have, think about how you want to use it over the next months, years, lives, generations, and think about how you might take advantage of the window that we have in the next 6 weeks that I think is unlikely to reassert itself during our lifetimes. So with that, why don't we open it up for questions?
Thank you very much, Adam. That was really very interesting, to say the least.